Good morning everyone, Chris from Skilled Wealth here. Just a quick update on the market. Today is the Thursday the 11th of October. For those of you who've been following along, you'll remember that I spoke on the 5th of October in relation to where the market was at, and particularly up around about these levels here. We were talking about the fact that the S&P 500, which is the chart that we're looking at right now, was starting to show some sort of bearish signs in that the value of the shares was starting to fall. And you'll remember some of these arrows that we had here. We were talking about the highest point that the S&P 500 or that the New York Stock Exchange had reached back in January of this year, 2018, and the fact that it did fall quite a bit. And this arrow here indicated that the lowest point that the market came down to was just shy of 12%, which is an official correction in the market. And then from that period of time, having come down to meet the 200 MA, we saw that the value of the shares actually started to increase again and made a very good recovery. So last night was an unbelievable night. It was a very large movement down. You can see here from this red candle, the value of the shares have dropped dramatically overnight. I expected them to hold sort of support at around about the 50 MA. Unfortunately, the 50 MA, which is the 50-day moving average, didn't end up being a support line, and the value of the shares continue to drop. And the basis for the reason for the drop is that the market is very worried. If you remember me talking about the Treasury bonds and the fact that interest rates in the US look like they're going to be going up a lot faster and probably a lot more than was expected, say 6 months ago. And that spooked the market quite a bit. And what we're seeing now is we're seeing people take their money out of shares and put them into Treasury bonds. And the reason they do that, they put them back into the bond market, is because a bond has absolutely no risk. So it pays a good return. At the moment, short-term bonds are paying over 3 and a bit percent, 3.2, 3.3%. And they're absolutely no risk because they're guaranteed and backed by the government, whereas obviously the share market isn't. So we're seeing people exit the share market at the moment, put their money into bonds. Now this, if you remember me saying, from our highs that we've had recently, and we're only talking about a week or so ago that the market hit an all-time high, this arrow here indicates basically a 5% drop. So this is the value that the shares would have to come down, and we can see that we've now just exceeded that today. So we've actually now got a drop that's greater than 5%. But in order for it to be an official correction, the value of the shares have to drop down by at least 10%, and that's what this arrow here indicates, basically a 10% drop. So we've come down considerably from our high. We've dropped just below the 5% mark. We've obviously halfway towards what would be an official correction. But in the meantime, we've got this large point here, which is a trend line, or in this case the 200-day moving average. And what I'm suspecting might happen here, and again we don't know until the facts of the matter play out, because nobody can predict the future, but what I'm thinking might happen is that we might hit this 200-day moving average, maybe come down past it, and then recover from there. And you can see that that's actually what's happened in the past with this particular indice, the S&P 500. It's come down to that 200, used it as support, and then bounced up and continued to move. And the reason for that is that there will be a lot of institutional buyers, a lot of big banks, hedge funds that are basically looking at the value of the stocks that combine the 500 or the S&P 500, and the value of those stocks today are really worth looking at. They become very cheap. So there'll be a big influx of money coming in to buy those cheap shares and obviously start to push the share price back up again. And that's what I'm suspecting might happen here. I'm talking to you on behalf of the Money for Life program. And the reason I mention that is that the clients that we have working with us in the Money for Life program don't actually care what the share price is doing. They don't care what the market is doing. As a matter of fact, there will be clients who last night made a good deal of money simply because the share price has dropped. And that's the beautiful part about the strategies that we teach. We don't care if the share market rises or falls or goes sideways. We've got strategies which allow us to make an income immediately up front, irrespective of that directional move. And if the shares do move in a particular direction, again, whether it's up or down, we can continue to protect our capital, and more importantly, we can make money out of that movement in the marketplace. If you're not quite sure what it is that we're talking about, I invite you to give me a call. Jump on board, have a look at our webinar. Go and have a look at a 45-minute webinar about what it is that we do, and I give you 3 demonstrations on the things that we can do so that you can generate a cash flow immediately up front. You'll see for yourself the actual type of trading that we do, one particular strategy that we do, and you can see for yourself just how easy it is. Guys, this is normal movement in the market, nothing to be afraid of. This really is something that we can deal with on an ongoing basis, and we do deal with it on an ongoing basis. Just because the market is dropping should not be a reason for you not to look at investing. As a matter of fact, now is the best time to be looking at investing, because think of it this way: if the value of the shares have come down so much that they now represent really good value, wouldn't you want to have a piece of the action when those shares start to go back up again? That's it for me, Chris Griffin, Money for Life. I look forward to speaking to you shortly. Bye for now.